Hi, today I'm going to talk about the commodities markets, kind of the structure of them, what they entail, and some recent developments regarding the markets and the industry. Little background information. Traded commodities fall into five categories. One is agricultural, which are grains, food, and fiber. Two is livestock and meat. Cattle is one of them. Then you have energy. An example would be oil and natural gas. And precious metals. Most important ones we know are gold and silver. And then industrial metals such as aluminum and copper. Another thing about the market, so commodities have higher risk and higher reward than that of stocks, and the most important reason for that is the issue of leveraging. As we learned earlier in the semester, for stocks we have 50% margin requirements. For commodities, for normal investors, you can have as little as 10% required, and for the CTAs and CPOs, which are commodity trading advisors and the pool operators, they're kind of like hedge fund managers for commodities. They can put down as little as 5%. So this just high degree of leverage can make the rewards very large, but also the losses large as well. The general state of commodities, on average, have been flat to slightly down in the past 18 months, and this is a big issue of demand. There's been lower demand due to slower growth in China and the Eurozone recession, and also there's been continued lackluster U.S. growth, and the commodities that have been most affected by the slower economic growth are oil and industrial metals. For oil, oil distillates such as gas, diesel, trucks, ships, things like, and then even some discretionary stuff such as traveling when the economy is doing well. Um, all of these things, when the demand's gone down, the usage has gone down as well. So that's been negatively affected. And regarding industrial metals, not the precious ones, but industrial metals like aluminum, copper, nickel, and zinc, which are used for things like construction, pipes, components of buildings. With a slower economic growth and a lack of demand, the demand for those have gone down, and that's why they've been negatively affected recently. The influence of the central banks is also very important on some of the commodities. The ongoing policies, such as the growing money supply, like quantitative easing, and the zero interest rate policies, are going to have the following effects on the commodities markets. There's expected to be a general increase in demand and price of precious metals over time. Right now, gold and silver, they're not, in the short term, it's been pretty stable, if not going down a little, but um, you know, to people, investors, the precious metals have an intrinsic value, something, there's a value to it relative to fiat currency such as the dollar, the euro, the pound. Those are just promises by a government. And when the supply of those continues to go up, people are going to take more utility in having precious metals, and those are expected to increase in the long term. And all commodities and well are at this rate expected to increase relative to the fiat currencies due to the central bank policies. And regarding agricultural commodities, these are different from the other ones. These are mostly affected by weather. The prices tend to rise in droughts, unseasonable frosts, or floods. Example of this was last June and July when corn and wheat, the droughts in the United States, they went up as high as 20%. And also, examples could be in South America, if there's frost, coffee could go up, or if there's unseasonable weather in Florida, California, that could drive up the price of orange juice. And a big development in the commodities markets. Last week, gold fell nearly 9% on April 15th, the lowest since the 1980s, in a single day. Mostly due to that morning, Goldman Sachs made a sell recommendation, obviously after they changed their positions, but they said that don't trust commodities and sell gold. And this started it started a lot of selling, pretty much a hysteria. And there was also an effect of the post-Boston bombing. Once everyone was starting to sell gold, there were one or two large leveraged positions by hedge fund managers that were long. They were long for gold, and when the value started going down, They didn't want to meet the margin requirements, and then they liquidated their positions. So this high volume liquidity happened very fast, and gold just free falled that day. And this chart right here shows an example. This is gold for the last month. You can see on April 15th, it starts just below 1540 and just drops all the way down below 1400. And then recently, the commodities that have done well are natural gas and cotton. Cotton's had pretty steady demand, and natural gas. What happened was in 2007 and 2008, and the units per price per like 1,000 cubic foot went from $20 to $2. So this drop, massive drop in price, just made the demand go up because coal didn't change. So companies, refineries, etc., they started to switch to natural gas as opposed to coal. So the demand went up big time. Now the price natural gas has gone up a little due to this demand. It's moved up to in between $4 and $5, roughly like a 30% increase. Nothing massive, like over 100%, but the demand is still increased. And the conclusion of all this is that the commodity markets are very volatile due to a wide array of reasons, such as economic growth, central bank policies, and also weather. Many of these things are very hard to predict, and despite recent stability and even going down in the markets, the future's bright for commodities are expected to increase due to the central bank and the state of the world economy.